this morning. Glad to have you. This is the Wealth Guardian Show, and you know what? When you retire, it's going to hit you like a ton of bricks, and you're not even going to see it coming. What am I talking about? I'm talking about the taxes that you may end up paying in retirement. I mean, it's going to be, in some cases, absolutely crazy. We're going to talk about that on today's show, and we're going to talk about some strategies going into retirement that you can use to avoid paying some of these outrageous taxes. But first, as I always do, let me give a big shout out and thank you to all of our men and women serving in our armed forces. Thank you so much for your sacrifices and everything that you do for us. So, you know, it doesn't make sense. It seems illogical that you're going to pay more in taxes in retirement than you are right now during your working life. But I'm going to show you today that it can happen. In fact, I'm going to give you a case study later in today's show that if this doesn't make the hair on the back of your neck stand up, I don't know what will. There's a couple that is going to pay in their life expectancy over $300,000 in taxes just on their required minimum distribution. That doesn't include pension income. That doesn't include taxes on 401k IRA distributions. That doesn't include the tax bite on the Social Security. Just on the required minimum distribution, over $300,000. You know, we just finished up a really successful taxes in retirement workshop, and I think most of the attendees were stunned at how much taxes that they could potentially endure in retirement. And, you know, we've always been taught that when we retire, our income is not going to be as much. So logically, we would think taxes are not going to be as high either. But I'll tell you what, the way the Congress and the IRS has our tax code structured right now, it is, I don't even know what the word is, sinful, I guess. I mean, we truly need tax reform in this country in the worst way. You know, and I've said this before, it is obviously a keystone part of the Trump administration to get tax reform, both on the corporate and the individual side. And I'm afraid that is already priced into this market. And if it doesn't happen relatively soon, and, you know, relatively soon in DC terms is a couple of years, I'm afraid the market's not going to take that very, very well. We are going to have, based on the success of that workshop, we're going to have a couple more. So if you didn't get a chance to attend that taxes in retirement workshop, we're going to do this again coming up in the near future. So stay tuned to this radio station or go on the website at www.thewealthguardians.com and let's take a look at when we're going to have the workshops and the times and the dates and so forth. So this is something that can be you can take this into your own hands and put in place strategies to avoid paying these needless taxes. I mean, you don't have to pay some of these taxes. You can restructure your portfolio. You can take advantage of Roth conversions. You can delay taking your Social Security to a point where you can maybe not eliminate all the taxes, but clearly reduce these taxes. So what the heck am I talking about here? Well, first off, I think what we have to do is we have to go and we have to look at the tax structure in our country. I'm talking about the brackets. A married couple filing jointly who is 65 and older are subject to, we're all subject to these brackets, but here's basically what happens. From $0 to $18,650, that is the 10% bracket. From $18,651 to $75,900, that's the 15% bracket. And then from $75,901 to $153,100, that's the 25% bracket. But did you know you have deductions and exemptions for a married couple filing jointly up to $23,300. What does that mean, Doug? That means that a married couple filing jointly, their first $23,300 worth of income is federally tax-free. Okay. Now that is the first piece of information that we can use to build a successful tax planning strategy in retirement. And you're probably saying to yourself right now, well, gee whiz, why hasn't my tax preparer told me this? Why hasn't my CPA told me this? And I'll tell you something. I'm not coming down on the CPAs of the world. It's really not their fault. They are trained to record history. They know the tax code inside and out. They take one of the most rigorous exams in the financial industry to get that CPA designation. But they're not trained, they're not schooled on strategies, how to avoid potential taxes in the future. Okay? It's just not a part of their lexicon. So don't blame your CPA if they haven't told you about these different strategies that you can use. So if you just joined us on today's show, we're talking about taxes in retirement and how they may potentially be higher than what you're paying now as a working human being. You could actually lose thousands and thousands of dollars in taxes. And this is just one of the many things that we're doing to help our clients make their money go further in retirement. And, retiring successfully, it's a lot more than just putting money in a 401k. It requires a plan for how to take your Social Security, when to take your Social Security, how to order your retirement accounts and take distributions from them, how to strategically take your required minimum distributions. It's about asset allocation, inflation. It's about health care. The list just goes on and on. Well, you're just guessing if you haven't thought about these things. So I want you to take the time to invest in yourself. I've got a 5-point master retirement plan that I will build for you. It's free. There's no obligation on your part. This analysis isn't going to cost you a penny. But for the first time in your life, you're going to have a strategy. You're going to have an orderly retirement roadmap. It covers 5 areas, taxes being one of them, how to take your Social Security benefit. That's another one. So I'd love to be able to do this for every listener, but I can't. I just don't have that much time. So for the first 10 people that call our office, I will set aside the time to build this plan for you. The number's 336-391-3409. Remember, it's just 10 of you. 336-391-3409. All right, so getting back to these taxes in retirement, how in the world can it possibly be that taxes can be higher in retirement than not? And I just told you a minute ago, everybody, first $23,300 of income is not taxed at all. Well, here's the problem, folks. It's how you take your Social Security and how quickly provisional income makes your Social Security taxable. It completely can drown out that $23,300 deduction and exemption phase. So if you don't know, the first $32,000 of provisional income is the first bracket. That's the gauge they look at. If you make over $32,000 of income in retirement when you're taking your Social Security, then half of your Social Security will be taxed at your tax rate. So what kind of income is going to get me over that $32,000 threshold? Well, here it is. They take half of your Social Security. To that, they add your adjusted gross income. So what's AGI, adjusted gross income? It would be any retirement account distributions, any pension money. If you're working part-time jobs, any of that's counted in there. And then to that, if you have tax-free interest from a municipal bond portfolio, they add that back into it. So you can see quite quickly your provisional income can easily get over $32,000. And if it goes over $44,000, then a full 85% of your Social Security benefit can potentially be taxable at your tax bracket. Remember I said earlier, I've got a case study that'll probably make the hair on the back of your neck curl. That's coming up, so don't miss that. And again, it's amazing because in this couple's situation, during their life expectancy in required minimum distribution taxes alone, they're going to pay over $300,000. All right. So what's one strategy to avoid this mess? Well, obviously, delaying Social Security is certainly a strategy to avoid paying tax on the Social Security. But in the meantime, while you're doing that, let's take advantage of these tax brackets we just talked about and use them to do some Roth conversion. Get your money out of the IRA that's going to be forever taxed into a Roth tax-free IRA that'll never be taxed again. And more importantly, when you hit 70 and a half, that money you have converted to that Roth account, that money is not subject to a required minimum distribution. Yes, you're telling me right now, I can hear it right now, you're saying yes. IRA conversions to a Roth makes sense, but isn't that taxable? It is. You're going to pay tax on that conversion process, but let's pay that tax while taxes are low. Let's take advantage of that 10 and 15% bracket. Pay those taxes now, especially if you believe, as I do, that taxes in the future will be higher than they are today. I don't care what Mr. Trump says. They're going to have to be higher, I believe, because we've got such a debt in this country. Give us a call at 336-391-3409. Again, let us build a 5-point master retirement plan for you. That's 336-391-3409. You're listening to the Wealth Guardian Show. My name's Doug Ray, and we'll be right back. Hey, and welcome back into the Wealth Guardian Show. Today's show, we're talking about taxes in retirement and how they're actually going to be worse in retirement, potentially worse in retirement than they are right now while you're working. And I know you're saying, how in the world can that possibly be? Well, it's just the way our tax code is built, folks. It's, when you start bringing in Social Security and distributions from retirement accounts, it's absolutely going to hit you pretty hard. And there are strategies, ways around this stuff. Going into the break, I was talking about Roth conversions. I love Roth IRAs. That's the one single thing you can do for yourself that will help you get out of this tax trap. It's called the tax torpedo. And that's when Social Security and RMDs, distributions, that provisional income we talked about, drag your Social Security income into taxable brackets. So tax conversions, Roth conversions to me make a whole lot of sense. We're sitting here with tax brackets right now of 10, 15, and 25%. The Trump administration wants to do away with all these brackets and bring it down to about 3 brackets like we had under the Reagan administration. I hope that legislation gets passed because it would be I think a boon for not just you, but the economy in general. And it's going to help the retirees. Now, the other thing that we can do is we can take advantage of the current tax rates because we have some pretty big gaps from $0 to $75,900. We're only in a 10 and a 15% bracket. So let's take advantage of those brackets and start converting enough of our IRA dollars up to, but not into, that next bracket. That way we're going to have a tax efficient plan to get your money converted from forever tax dollars to never tax dollars. And more importantly, for you folks, that are 70 plus, you don't have to take a required minimum distribution on this money. Now, I know there's going to be plenty of you out there. I've got lots of clients who have got to tap into their retirement plans in order to make their retirement successful. And that's okay. That's all part of a planned strategy. But there's also a lot of you who are blessed and fortunate enough not to need to take distributions from your IRAs, but you're going to be forced to take a distribution starting at age 70 and a half. In fact, the required date, you have to take a distribution from your IRAs by April 1st of the year following your 70 and a half birthday. Now, if you wait until that year, that means you got to take 2 required minimum distributions. Let's go into a case study. I teased you a little bit, and I told you if this one doesn't make the hair on the back of your neck stand up, then nothing will. So, we had told you a very successful taxes and retirement workshop a few weeks ago. We're going to have another one coming up in a few weeks, so stand by for information about that. But this couple came, and let me tell you a little bit about this couple. They're a professional couple, and he retired recently as a pharmacist, and she's a doctor. And she makes a decent wage. She doesn't make she's not a rich person by any stretch. She is a doctor for hospice. And, I don't know how in the world she does what she does, but I'm so grateful and thankful that she does do it. I mean, those hospice people are just incredible human beings. So anyway, she's a bit younger than him, and she wants to work a couple more years. So we went and we did some retirement planning for them. And in the first few years of their retirement, it's not too bad. The taxes are not going to be outrageous. They're going to be in the actual effective tax bracket of around 10%. Now, they're in a situation where he's got a pension. They live a relatively modest lifestyle. They have little to no debt. So their standard of living is not outrageous. I mean, they can get by very successfully on $5,000 a month and live their normal lifestyle. That's not the issue. The other thing is we did the Social Security optimization for them and discovered that, yes, indeed, in their situation, that the way they optimize their Social Security is both of them wait till they're 70, taking advantages of all the increases in the delayed credits in the Social Security package, and start their Social Security benefits at 70. Now, guess what happens around that same time frame? They have required minimum distributions almost coinciding with Social Security income. So in their situation, by the time they reach 70 and a half, it's projected that their qualified plans, their IRAs and so forth, combined are going to be roughly $1 million. Okay. So when you start calculating your required minimum distributions, basically the IRS gives you a table, and it's based on longevity. And roughly speaking, the first year RMD is about 3.75% of your total qualified plan assets. So if they got $1 million, let's just round it to $1 million, and you're looking at something around $35,000, $38,000. Okay. So once you take that, remember what I said those Social Security brackets were? Provisional income. It was what? It was $32,000, then $44,000. So now they've got RMDs that launch them past the first Social Security threshold. Plus he's got $20,000 in pension coming in. Now they're launched past the $44,000. So 85% of their Social Security is going to be taxed at their tax rates. So let's look at their situation. They have a total of $72,000 in Social Security benefits. Remember, they were both professionals. They've been maxing out their contributions the whole time. So $72,000 is taxable at their tax rate. They have required minimum distributions of somewhere around $40,000. They have a pension of $20,000. Bottom line is their total tax is going to be $37,000. That's just federal, folks. That's not state. I hadn't even gotten there yet. Their tax bracket is 25%. Their federal tax rate is 16%. Why is that important? Because up until they hit Social Security benefits and required minimum distributions, their effective tax rate was less than 5%. It's almost tripled. It has almost tripled on them. This is what we call the tax torpedo. Now, what can you do? Well, Roth conversions. I preach Roth conversions, but there's other strategies. If you don't need that required minimum distribution, like in this case, you can gift it to a charity and get a tax deduction. Or let's say you want to make sure that your family is taken care of. You've got children and grandchildren that you want to make sure that that they're taken care of. Why not take that required minimum distribution or some of it and buy a life insurance policy? Think about that. Buy a life insurance policy that covers both of you, so it doesn't pay a death claim until the last surviving spouse passes. Those are cheap policies. You can get a lot of death benefit for very few premium dollars. That way you're passing on a tax-free legacy to those children and grandchildren that you want to protect in the future. So again, today, if you just joined us, we're talking about taxes in retirement and how this case study, I was just talking about how this couple, from the time they turn 70 and a half and have to start taking their required minimum distributions until their life expectancy, which we will call about 85 years of age, are going to pay over $300,000 in federal tax just on their required minimum distribution. Could that be you? Are you in that situation? This is just one of many things that could make your money go further in retirement if you figure out a strategy to avoid having to pay those taxes. Retiring successfully, folks, it's just a lot more than putting money into that 401k plan as you work. It requires planning. It requires learning the best way to take your Social Security, learning which accounts to withdraw from that is tactically tax efficient, learning about ways to minimize your required minimum distributions. And if you don't have a plan going into retirement, folks, you're just guessing. I'm sorry, you are. You're just guessing. You're setting yourself up to fail, pure and simple. So what I want you to do is I want you to make time, make the investment time, make this time for yourself. I want you to start with calling us up and let's give you our 5-point retirement master plan. This analysis is not going to cost you not one penny. I'm not going to obligate you to anything. You got nothing to lose. Many of the strategies we talk about work best for people who save for retirement. I mean, obviously, you've got to have something put aside for retirement, but I'm going to do this for the first 10 callers of this radio program. Wish I could do it for everybody. I just don't have the time. But for the first 10 listening today that call us, 336-391-3409, I will do this plan for you. It's going to look at Social Security optimization. It's going to look at required minimum distributions. It's going to figure out which is the best accounts to take money out of first to avoid taxation. We're going to also have a strategy for you in terms of getting your forever tax dollars into never tax dollars. So call us at 336-391-3409. All righty. So we've talked about a lot of things today. Lots of situations where you may never thought of how taxes in retirement can be more than you're paying right now. Unfortunately, folks, our tax code, the way it's set up for you W-2 income earners, is, in my opinion, disgraceful. I mean, you have very little tax advantages anymore. About the only thing you have in terms of write-off is mortgage interest. And by the time you get into retirement, usually most of you have your mortgages paid for. So there goes that. So you're literally down to the standard deductions and exemptions, which is about $23,300. I want you to take advantage of our offer today. Come in, let's sit down and talk, and let me do this master 5-point plan for you. Let's stop this incredible taxation of your retirement dollars today. Don't get into retirement without a plan. Call us at 336-391-3409, and I'll see you next week.